Happy New Year, everybody, and welcome to the Middle Class Investor. It's been a couple of weeks since I've been on. Um, with the holidays, I had a vacation, um, refreshed and ready to take on 2017. Well, we are looking at what could possibly be the last little move up in this huge move that goes back almost 10 years, 9 years, I guess, 8 years, something like that. Back here to 2009, 8 years. And, it's certainly been slowing down. It started slowing down here in 2014 or 2015. And then 2016, the first part of 2016 really ramped up, but then it really hasn't been moving that much. Now, I'm talking about relative to this whole up move. The Trump rally, as they're calling it, was really, this kind of area right in here at the very beginning, and you can see this 1, 2, 3, 4, 5, 6 weeks really ran up hard, but then has been chopping sideways a little bit, and it looks like to me, just because we're starting to, if you count these, you're starting to run into, what looks like could be the end of the move. Now we're probably still a month or two away from the very end of the move. So what does that mean? It means we probably have a a down up, maybe up down little sequence kind of coming. It looks like to me this wants to finish a little bit, and we'll look at a chart here in a minute that kind of reflects the same thing. You might see a retest down here just below this pivot, and then your final move up into the end of this whole move that started back in 2009. There's a guy that I follow sometimes. Sometimes he doesn't have good information, but he spends a lot of time creating these counts and stuff. This is all Elliott wave stuff. But the thing I want to point out is this green here. The way this works is it's a fractal. So you can see here there's a 1, 2, 3, 4, 5, which makes up the blue 3, right, from 2 to 3. And then, but you can still see for the blue, he's saying, and maybe even for the green. For green, we still have a 4 and a 5. And then for the blue, we're going to have a pullback into here for the blue 4 and then up to 5. But notice what happens when it gets to 5. That's 5 of 5 of 5 of 5. This is what's so critical about where we are in the market right now. And this is what I think this type of model is good for estimating. It's very difficult to trade with this model because you don't know if this is one or if it's just one of one, right? One of three or whatever. So it gets complicated, but he's got this model that goes all the way back to 2009, and he's got us ending this whole move in 2009 at 1, 2, 3, 4 degrees, at least 4 degrees of trend, and maybe more. What does that mean? That means, well, first of all, a very common move in the market is once you finish 5 waves, which you would finish here after the blue 5 is complete, the market goes back to the wave 4. So it would go back to here, usually, and then kind of rally up a little bit, but not to a new high, and then back to this wave 4, and then rally up a little bit, but not to a new high, and then back to the previous wave 4, which is way back here in 2009. So, in other words, the beginning of this whole rally is just a wave 4 in some huge rally, okay? So you could have a situation not saying it has to be this way, but the way they've got it drawn here, and it's certainly something we should keep an eye on, is that this whole move might get retraced. And that might even just be the start. If we really have 1, 2, 3, 4, is that right? 1, 2, 3, 4. Well, including green. He didn't put the green. Well, the green 5 is there. So 1, 2, 3, 4 degrees of trend. We could be in for a very substantial change in the market. In other words, this might be the 1, 4, but the bigger 4 you got to look out for. I'm sorry, that wasn't it. This might be, let me go back to 10 years here. Let me go to 20 and just put on a weekly. So there's a 4 here, a 4 here, a 4 here. So that's, what is that? 1, 2, 1 here, 2, 3. So we got to go back even further to find out where the next one is. The next one could be right here. This could be the 4. So as crazy as this sounds, this could go all the way back to 1987 lows. Now, obviously, you don't want to just count on that, but it's something to watch. We're just, it's hard to predict the market that far out in the future, but I think you have to respect the number of degrees of trend that we're ending here. This is my only point, is you just have to respect the fact that 1, 2, 3, 4 degrees of trend are ending here, and we could be in for a very substantial move. Now, it's important to know where the moves would pull back to. So the first move would pull back into this area, which is not on the chart yet. In other words, it hasn't even happened yet. So once this little up wave is complete, we get a pullback, then that'll be the 4th wave low, then we'll have 5. So the first pullback area would be to the 4 wave low, get a little rally up, and then to this 4 wave low, 4th wave low, and then rally up, and then all the way back to the 2009 low. So that in and of itself is just a scary proposition. So I think it's something to be aware of. I think it's something we should watch. Again, if you're looking at it here on the S&P chart, what his chart is saying is we go up a little higher, maybe to there, we pull back to here, and then 5th wave, final rally up into here, and then pretty quick move back down to here, some sort of A, B, C, okay, and then a quick move down to here. See, below this low here. So this right here is enough to damage your portfolio. So I think it's important to watch closely, and what we'll be watching for is, first we'll be watching for a pullback to here and then a new high. But then secondly, the thing we'll be watching for is, after we get this pullback, do we come back to a lower high? This right here is super critical from a 401k standpoint. If you pull back to a lower high and start to roll over, then you got to cut the ties with the market. I think you cannot afford to risk, this kind of move, or even deeper than this, in your 401k. It's just too hard to recover from. And if you got to be a little bit on the conservative side, I think it's worth it. Now, every one of you have to make your own decisions about that, but that's just my opinion. But like I said, I think when you're talking about time, the market, when the market's going up, it takes a long time to get your money, and you can lose it really, really fast. So I think you have to really respect the fact that we could potentially be coming to a new high, maybe in March, somewhere around there, March or April, and that new high, after it pulls back, will not be rallying to a new high again, maybe come first part of June or something, and that we've got a big pullback. So I can't stress that enough. Hopefully your senses should be heightened here in the first 6 or 8 months of this year. All right, let's look at interest rates. Very, very important market. I've been talking about it for a long time. As you know, the Fed raised rates, but the big number, the big key number is the 10-year yield. And look at what it's done. In very short order, it's way up here now. Now it's in a pullback now, so it could pull back at least to this gap and maybe even lower, maybe even here down below 2 at like 1.9, this area 1.9. But then interest rates are, as they move up rapidly, and I think they will move up rapidly. It's going to really put a hurt on people's fixed income investments, and it could potentially put a hurt on the market in general, although it doesn't have to. But certainly, if you're not at bonds, you should be looking to get out of bonds as we pull back to this gap and potentially back here to 1.9. I think this 1.8246 area is a key area. If you haven't already opened up your statement and just flipped out, if you can wait until we pull back into this 1.9 area, I think you'll be much happier with your account balance. But just keep that in mind. Let's look at the 13-week Treasury. That's the short-term yields. And you can see I've got a note on here that when we started trading above this line, the Fed would raise rates. And of course, we traded above the line for 1, 2, 3, 4, 5 weeks before the Fed came out and raised rates. And then, of course, they raised rates. So we'll look for a new area of resistance where the Fed will probably raise rates. Probably have to go back to a fairly long-term chart because this was flat for so long. It was below this 1.5 for so long that you probably have to go way back to see an area above this that's also above that. So I'll do that, and hopefully by the next time we do this program, we'll have some information about that. All right, what do we usually look at? Volatility, a little bit out of practice here. You can see volatility is very low. It's way down here at the bottom of the chart. And we're probably in for some sort of pullback because you can see here these are very low values for volatility, and my feeling is there's probably just not a lot more low volatility you can have here without some sort of spike up. I don't know. We might get a bar that maybe comes down and touches that again, but then I would expect volatility to spike up to at least this 15 area before it pulls back and makes another run down here. Although I don't think it'll go below this line. So even though we're gonna pull back a little bit and actually make new higher highs, I think you could see volatility not come all the way back down to where it was previously. Keep an eye on that. See what happens. The world markets are not, in general, they're not doing as good as the U.S., but the U.S. is kind of having a tendency of pulling everybody up a little bit. And you can see Germany has broke out of this down channel and could be making a run to this resistance area, or could be could just be a counter trend rally. So we'll have to watch that closely. I still think Japan's going to make its way up into this resistance area, but it hasn't yet. So we'll just keep an eye on it. The UK is making a series of higher lows, and could ultimately get up here and make new highs. Not saying it will happen. I'm just saying, it has broken out of this flag area, broke out, retested, still moving higher. Now, if it rolls over here and makes a new low here, then maybe we have to reevaluate that. All right, let's go look at the dollar real quick. The dollar still hasn't got into our resistance area. I still think it will. There's a possibility the resistance area is drawn a little too high, potentially, and maybe it won't make it that high. It's already made new highs here compared to that high and that high and that high. But it does look like it's pulling back, and maybe it's just a pullback before it gets into, this new high ground here. So, and maybe it's done pulling back, but maybe it goes to there and then pulls up into there. So keep an eye on that. There's a lot of talk about the dollar. I mean, a lot of noise in the marketplace about the dollar, about currency flows in general. If you look at the the euro US dollar, a lot of talk about the euro. You can see it's hit this support area. It looks like it wants to bounce. If it does, it'll probably bounce up here and then roll over again. Probably going to parity between the dollar and the euro, 1-to-1. We're pretty close to that now. So if you look at oil, oil continues to kind of grind higher here, although last week was down. But after this big move in oil down, you would expect that it would be up some. I think oil was the number one performing out of anything last year. It was up 45% or something like that. So, but I would say that oil's rally is getting a little long in the tooth, and there's a lot more risk here. Going forward, I noticed the oil companies are all piling back in. I think they think this is the bottom, and maybe it is, but this looks kind of counter trendish to me, and so I would say we're at least pulling back into this little yellow area here, and potentially down into this yellow area here. Let's see what other. I mean, we could look at some other currencies. I don't think most people that watch this are not as involved in the currency market, so I'm not sure it's worthwhile to spend much time on that. But I do want to point this out again, that looks like maybe we get a little bit further pullback for 4, we get a little 5 inside this 3, and then we get a pretty good pullback to this 4 before we make a new high. But I do want to point out again, we're according to Elliott Wave, which I think is pretty good for long term. I think it's important to keep an eye on this from a long term basis. We're at 4 degrees of trend, and at a minimum, what's going to happen is you get a pullback back to this low here, which was the 2016 low. So the lows that were in 2016, we should travel beyond that and actually make a lower low than this low at a minimum. Now after it rallies, we'll just have to see if it rallies to a higher high, or does it rally to a lower high. And if it rallies to a lower high and pulls over, then we start looking for the next pivot down, which is way down here to the 2009 lows. So stay with me. I don't want to make this an Elliott Wave class or anything like that, but I do want to point out that in the very long-term picture, they do seem to have this wave structure down, and I could show you where they've predicted this move in oil, which would have been a pretty lucrative move if you would have bet against oil back in here when they were talking about, well, right along in here they were talking about if this rally didn't go all the way to new highs, in other words, take out this high, this rally here didn't take out this high right here, that oil was going down. And sure enough, it didn't take out that high, and oil slid a bunch. So I think their very, very long-term picture is very good. This was a 5-wave move here. They called that. They said that oil was at least going to this area here around $50. and it ended up going all the way to $33 or something like that. So um, I think from a very large picture standpoint, it's worth looking at, and I'll continue to reference it here in this YouTube channel. All right, everybody, that's it for this week. I don't anticipate missing any weeks here coming up. If I do, I'll try to give you some heads up, but we're just going to come in here. We're going to talk about the markets, how they would, going to impact your 401k. That's the goal. The goal is to really, not so much to help you make a lot of money so much as much as it is to keep you from losing a lot. And I'm trying to point out the areas that I think are really going to harm investors, and those are the areas that I want you, to consider staying away from. So, all right, until next week, everybody. Thanks for coming in, and we'll talk next week. If you have any comments or anything, just you can comment here on the YouTube channel, or you can go to Middle Class Investor, which is @investor class, and you can comment there. I take a look at it pretty regularly, I guess, make sure nobody's trying to communicate with me. So, all right, everybody, take care. Thanks for coming in. We'll see you.